Hello everybody, and welcome to Module 3, the 3 pillars. Now, the 3 pillars is the balance sheet, income statement, and cash flow statement. And we've already touched on those in Module 2, and now we're going to take an even deeper dive into these. And by deeper dive, what I'm going to do is I'm going to teach you how to tie out the big balances, the material balances on your balance sheet, how to tie them out into your income statement, and how all that's going to flow through your cash flow. Now, this is important because, as I've said before, you can't analyze your data if your data isn't accurate and correct. And so I'm going to show you how to tie it out, how to make sure those balances are correct, so that when you get done, you can then actually start doing your analysis. I've also built into this module some of the more common ratios that you'll find, such as the current ratio, cash flow ratio, so on and so forth. So those are going to be in here as well, and I'm going to show you how to kind of tie those in. Again, we're going to use those core statements that you saw in Module 2. We're going to continue to use those so that you can get some more familiarity on how everything's going to flow through. Another thing within this module is I've had a separate session on just the 30% cash roll. Because that is such a key item, I didn't want to just lump that all in with the asset side on the sessions. That's just going to be its own separate session. Also, as a bonus, I have in here a session strictly on internal controls on the cash flow, on the cash cycles. That is because I can't just put that in one slide and go give you everything you need. And so I put together a separate session just on the internal controls. And again, if anything, if you're going through this, please make sure you review that, because the internal controls are very key to your business. So with that, we're going to go ahead and jump into the 3 pillars, starting off with the balance sheet. Thank you. Welcome everybody. We are now in Module 3, the 3 pillars. This is Session 1, the balance sheet. As I said in the introduction, we're going to be going over many of the main items within the balance sheet, and in particular, how to tie out all your information to make sure what you're looking at is accurate and complete, and to allow you to better analyze all your information. So let's go ahead and get started. So in this, we're going to be reviewing cash. Obviously, that's going to be probably the single biggest item we're going to review. Now, if you're a manufacturing company, the other big item is going to be the inventory. But cash, everybody needs cash to operate their business. I don't care who you are. So we're definitely going to hit that one first. Accounts receivable. We'll go through on how to tie out your accounts receivable, how to analyze it, how to determine whether or not you need a credit policy, how to determine what your days in AR are. We're going to go through what those ratios mean and what they tell you when you calculate them. Inventory. We're definitely going to go through this, and especially if you do any kind of manufacturing, even if you're just reselling a product, you need to make sure you have a grasp on inventory and all the costs that go into inventory. Property, plant, and equipment, i.e. fixed assets, we'll go through that, and we'll show you a summary roll forward schedule on that, so be prepared on that. Accounts payable, again, that may sound like a mundane item, but there are some key things that you need to be considering when you're tying those out. Deferred revenue, for those of you who are unfamiliar with this term, we'll be going through that and the importance of how to track that, especially if you do a service type business where you get paid ahead of time, such as retainer. Notes payable, again, that's going to be your debt. Again, that's one of the areas, my 20 years of doing audits of financial statements, I'm, can count on multiple times that, the notes payable, the debt section of a client's books were messed up, and when they got fixed, it impacted a lot of their decisions once we got the numbers corrected. Equity, again, we're definitely going to hit this one, because if equity's off, that means you got some other balance sheet account off as well. So we're going to go through that process. And then, of course, like I say, we're going to discuss the current ratio and cash ratio. Again, these ratios are important to, one, be able to calculate, and two, understand, and as well so that when you're going for a bank loan, that's one of the big things they're going to look at, is they're going to be looking at those ratios. So we'll go over that process as well. So first up, cash. Now, Many of you know you have cash, many of you know you have a bank account, but I'm guessing there's quite a few of you who don't fully understand the bank reconciliation. And so I've got a template and we're going to walk through it here in just a second, but I wanted to kind of go through these first little items. Bank reconciliation, how to reconcile, why you reconcile, and when do you reconcile. So we're going to go over that here with the template in just a second. And segregation of with your cash account, you want to make sure that you segregate out your operating cash from your reserve cash, from the cash that you need to use to pay the taxes, to pay for sales tax, pay your federal taxes. That's very key in your cash account. So when you're going through your business, and recall when we touched base on the 30% rule, on your business, when you've got sales, and in particular sales that you have to withhold sales tax on, you need to make sure that that cash is segregated out. Again, I'm going to show you here on this template. I can talk about it on this slide, but the template will be easier for you to be able to see what's going on there. And then internal controls, like I said, there's a separate video on the internal controls on the cash, and I highly recommend you review that video, because I can't stress enough, and I'm also, as I've said, I'm a forensic accountant as well, and I've done several investigations where the cash account was not reconciled, or there were weaknesses in the control process in cash, and that resulted in theft. Keep in mind, if somebody were to steal from you, they are more or less stealing from your bottom line. They're not, if you think about your income statement, they're not stealing from your revenue. They're stealing from that net income number that's down at the bottom on your income statement. So keep that in mind. That's why internal controls are so critically important. So let's go ahead and jump into the template, and we'll go back through all this information in more detail. So let's go into the template. So here's the template. Again, you can bring this up and follow along as we go through this. And this is what we consider in the accounting world a summary of the bank reconciliation. In this next tab, this individual bank will have individual items here that reconcile out. But I just want to show you this first, then we'll jump into the individual one. A lot of times a summary bank rec is good for when you have a whole bunch of accounts, but you want to see all the reconciliations all at once on one page. And that's why you see this overall summary. You don't necessarily have to do this, but you do need to do the individual bank reconciliations. And like I mentioned in a previous module, your software, especially QuickBooks, will do a bank rec for you. It'll kind of go through the process. And one thing that some accounting softwares were notorious for is if your bank accounts didn't reconcile, you could literally click a button that says force the reconciliation, and it would force it and say, all of a sudden come back and say, congratulations, your bank statement reconciles. Never ever do that. Because if it doesn't reconcile, you need to investigate, because like I think I've mentioned before, I once found a fraud, and it was because a bank reconciliation didn't reconcile, and it just happened to be one of those this lady was stealing for years and years and years. But that is one of the main things here. So as you can see on here is the operating account. Again, like we say, you want to have an operating account. That's going to be paying all your standard bills. Then payroll account, and then I've got these two other accounts sitting up here just so you can see that it's perfectly acceptable to have accounts at different banks. So that's just why I just put in these fictitious ones here for that. But as you can see, operating account and then a separate one for payroll account. Now if you recall, when we went through the module 2, we talked about a zero balance account. Well, this is what a zero balance account would be. Your balance per bank, outstanding checks, reconciles to zero. Just so happens I put $1 in there, so it didn't, you had a difference. But so let's go through the actual bank reconciliation process. So let's jump into this individual tab. Go up here. So when you're reconciling your bank account, and like I said, your software will do it for you, but I highly recommend you take a couple stabs at doing it manually so that you fully understand what's happening. So in this case, This is for a month end, and I didn't put a date in here, but let's just say it's for the month ended October 31st, 2019. So this is the balance per bank. This comes straight from the bank statement. Next thing you need to do is say, okay, what outstanding checks do I have that have not been cashed yet? The reason being is this bank balance, because those checks are still outstanding, it hasn't hit the bank balance. If we were just to completely ignore the deposits and transit outstanding checks. If we just said, no, we don't want to look at this. Let's just do this real quick so we're not looking at it. We just said, here's my balance per bank, here's my balance per the general ledger. You'd be like, well, why is that they're not working? What I've seen some people do incorrectly is they just look at the bank statement and say, oh, I've got $45,000 in the bank, and they assume that's the money that they have. In reality, that's not what they have, because they have, in this case, outstanding checks, in this case 14,000. So when you're doing your bank rec, your outstanding check should always tie to a listing of the outstanding checks. So in this case, I just put in these fictitious checks in here, and you see all these checks in here, and that total, it adds up to the total outstanding. That's what you want. You want to have a list, because you need to know what checks are outstanding, when were they written, and for what dollar amount. Because what can happen in some states, and I know particularly in the state of Colorado, you have to escheat the checks, ESCHEAT, and what that means is if a check has been outstanding for a certain period of time, I believe it's 2 to 5 years, depending on what state you live in, you're technically required to submit that check and the amount to the state with a listing. So let's say in this case, if all these checks were within the threshold, let's say 5 years, and they had never been cashed, you would send $14,000 to the state of wherever you live, along with a listing of all the checks. Now, I don't know of any state that heavily patrols this, so I don't know if that would ever come up, but that is technically a law in some states, that if a check has been outstanding for quite a while, you do need to escheat them back to those respective states, and then they would do some sort of payback or website that a person could go and bring up their name to see if they're owed anything. But in this situation, outstanding checks 14,000. Now deposits in transit, with our electronic information nowadays, you're not really going to have that many deposits in transit. The only time I think you'll have a deposit in transit is if you go to the bank on month end and you go in after 3 o'clock. I believe that's the cutoff time for most banks is if you make a deposit after 3 o'clock on the last day of the month, it doesn't hit your bank account until the following business day. So that technically is considered a deposit in transit. So you deposited it, it hit your general ledger because you said, hey, I got the cash in. You recorded the cash in your general ledger, and then somebody took it to the bank and dropped it off. But in this case, in this particular situation, it doesn't hit this bank account till the day after the month end. So deposits in transit. Another item that may or may not show up here, depending on how it goes through, is finance charges. So finance charges, sometimes they hit the bank, but you don't hit your general ledger. So you can theoretically have a reconciling item for there if you just don't want to take the time to go back and dump it into the correct month. That's solely up to you, because a lot of times the finance charges are like $20 or something like that, so they're not that big of a deal. So then we come to what we call the calculated balance. So we say, here's the balance per bank, here's the outstanding checks, plus deposits in transit, here's the calculated balance, and then you compare that to your general ledger balance. In this situation, they happen to both equal. But if, let's just say my general ledger balance was 30,000, well, now I've got a difference of 28.54. Well, that if you have any difference outside of like $1 to $2, you need to investigate it, because there may be issues with a journal entry got posted to cash that shouldn't have. You could have a deposit that should have been deposited that apparently didn't get to the bank, or there could be a check that got written say a manual check that you didn't pick up in your outstanding checks, you always want to investigate your differences. Don't just let them pass, because that can bite you very quickly, because sometimes an issue here could lead to other issues. So in this situation, we come back to our overall summary, and as you can see, I actually linked these to this tab so you can kind of see how it flows through. And then you have the same situation with these other accounts. What's the balance per the bank? What's the balance? What's outstanding? Any deposits in transit? What's the calculated balance? General ledger balance. So again, we want all these to reconcile. In this case, I purposely put a $1 balance here just so you can see sometimes you have small differences, and sometimes you'll have a difference that one is negative $20 and one's positive $20. If the differences net out to zero, you probably just need to do a journal entry between your cash accounts, but I wouldn't get too worked up about trying to investigate it. But if your differences don't net out, then you definitely want to look at that. So this is one of the biggest controls you're going to have in your company, is reconciling what's in the bank, what do I have outstanding, what's in transit, what's calculated. The reason why this is a biggest control is because your bank statement comes right from an outside source. In the world of auditing, we consider this a third-party confirmation. So your bank's coming back and saying, this is what you have here, and that's why you want to reconcile back to it, and you want to make sure your bank reconciliation is done timely. I can't stress enough, I've seen so many times when I would audit companies, and we're talking large companies, that they wouldn't reconcile their bank account for like a 1 or 2, 3 months. There was one client I had, they were very large, and they would be like 2 or 3 months behind on their bank recs. No, that is not acceptable. You need to reconcile usually within 10 days. I can understand, obviously if you're slammed and you're in your busy season, and you're just hammering sales out left and right, 15 days you can let it trickle out that, but don't go past that. The reason being is if there's errors or issues, the longer you wait, the harder it's going to be to go and find it and fix it. Also, you can't make an informed decision if your cash account, if that account is not reconciled and accurate. A lot of your decisions you're going to make on expansion or product or what have you is going to be skewed and might be an incorrect one based on incorrect information. So again, make sure your cash account is reconciled. Down here, I've put together a quick little schedule, and we're going to go over this more when we go through the 30% cash reserve. But in here, I just put together a quick little synopsis. If you recall, you want to have about 30% of your revenue showing up in the cash account. Now, if you're just starting out, it's going to be very small percent of your revenue, and I understand that, but that's your goal to get to that point, is all your operating your reserve cash in total will equal 30% of your gross revenue. And then of course here, the income tax reserve, you want about 40% set aside. And then of course I put in some formulas here so you can see, are you there or are you not. So this is a good little thing if you just want to just use this part of the template for your own personal thing. That's perfectly fine. Again, this I put prior year gross revenue. If you're just starting out, you might have to do what's called annualize it. If you're 3 months in, you're going to take 3 months and then you're going to extrapolate that out for 12 months. So just so you can see how these formulas work, let's say in this situation they only had 100,000 in revenue. So you can see here, formula flipped over and says, okay, yeah, you've got plenty reserved. Let's say in this case you had 90,000 in net income. Yep, need one more zero. And so then the formula comes through and says, oh, you're under reserve. So again, I just built this in here real quick so you can utilize, you change these numbers, you make sure your reserve, what the cash you have in there, and then it'll come back quickly and tell you, are you good or are you not, where you should focus and where you're off possibly. So this is the bank reconciliation. Like I said, I can't stress enough, very, very important for your business. So let's go ahead and continue on with the presentation. So accounts receivable. So it depend whatever product you sell, as long as if you happen to sell on credit, you will have accounts receivable. If you're strictly a point of sale cash basis, and by cash basis I mean you don't sell on credit, you won't have any accounts receivable. But most of you will have accounts receivable. So let's go ahead and take a look at this. You want to reconcile your accounts receivable to what's called the subsidiary ledger. So your accounts receivable account on your balance sheet is what we call in the accounting world a control account. And what that means is it's saying here is the balance that has flown through from based on journal entries, based on subsidiary ledgers, what have you. It's saying this is the total number that shows up on the balance sheet. So that's why it's called a control account. Your subsidiary ledger account is going to be a listing of all the people who owe you money, from Jane Doe, John Doe, Ace Hardware, whoever owes you, and there'll be a listing of what they owe you, how long it's been outstanding. That's called the aging report, and then that should tie to your control account. Now, I know it may sound kind of unusual for you to go tie a report back to your balance sheet, but trust me, it does happen where those two don't match, and that's when you want to make sure you have it reconciled. So in other words, if your subsidiary ledger, let's say it says 100,000 and your control account, your balance sheet account says 110,000, you got a $10,000 difference. You need to make sure you understand why. It could be a legitimate reason. It could be a receivable that didn't get entered into the system, into the subsidiary ledger, but you want to make sure it shows up on the balance sheet, which is fine. But you need to reconcile and denote why there's a difference. Now, if you don't know why there's a difference, then you need to go through that account, the control account, and see what got posted there. Because a lot of times when your subsidiary ledger doesn't match your control account, it's because a journal entry got posted, usually either got posted to a wrong account or just got posted incorrectly. So that's key, because again, we're going back to, we need to make sure the data on your balance sheet is correct. Collections. Now, when you have accounts receivable, you have a credit sale, you need to set a policy on when you will review an accounts receivable for collection issues. Now, a lot of times I've seen where people, they have a accounts receivable and it's been sitting out there and sitting out there and sitting out there, but they don't really, what we call work the accounts receivable, make sure it gets collected and so on and so forth. You need to set a policy. And even if it's just you and your business, set a policy right now and follow your policy. Because what's going to happen is your company gets bigger, you're going to have other people working on that, and you want to make sure they understand if accounts receivable get to 45 days, these are the process procedures we're going to do to make sure we get collections. Because the longer accounts receivable is old or outstanding, the less likely you're going to actually collect. And remember, that is cash. That's cash that's owed back to you. So if you don't work those, you don't call those people and you say, hey Joe, you need to send in a payment, need to get on it, and sometimes it's sometimes it's an uncomfortable call, but keep in mind, these people have your product or got your service and you don't want to give it away for free, so you need to make sure you get it collected, and then make sure you have it in place as to what's the process. Now, okay, at 45 days I'm calling Joe, at 55 days I'm emailing and sending a letter, type situation, whatever it may be, but make sure you're more aggressive on the front end, because the longer it gets outstanding, the less likely you're going to collect. And then establish credit limits, especially if they are a brand new customer to you. You may decide, well, I kind of know them, so I'll let them buy on credit, but you need to set limits. In other words, a lot of times there's software or accounting software out there that you can set up when you're setting up a new customer. You can say they are not allowed to go above $10,000 in credit. If you don't set that credit limit, what could happen is you have a person coming in and they're buying accounts, your product on an account, and the balance keeps getting bigger and bigger and bigger. If you don't set a credit limit, it says, okay, once they get to this threshold, they can't purchase anymore. And that is key to controlling cash, especially for new clients that you have. Now, if you have an established client and they tend to just pay late, and that's just how they are, well, that'll be a business decision for you. I know there are certain oil and gas companies, large oil and gas companies, that for whatever reason they just don't pay until 45 days. It's just how they function. I mean, they're good for it. It just takes them forever to go through and get that. So again, establish a credit limit so that you don't wind up, giving away product to somebody who you wish you wouldn't have had you taken the time to analyze it. So, and like I said, a lot of times accounting software, you can set it up within the software itself, and so it automatically will flag or let you know that, hey, this person's gone above that. AR analytics. Now we're going to jump into this in just a second, but I want to go through these bullet points real quick. When you're analyzing your accounts receivable, obviously you're going to look at the aging report. That's an important report. The AR aging will list the accounts that are 0 to 30, 30 to 60, 60 to 90, and give you a percent on how much is getting older. But you also want to analyze, what's my percent of accounts receivable bad debt. If you're writing off quite a bit, that may indicate either you need to set up a tighter credit allowance, maybe tighter credit limits, what have you. But you need to make sure you're analyzing your bad debt. You also want to analyze your AR to sales. Like I mentioned in the previous module, as an accountant, I can make you as profitable as possible. And the easiest way is to debit accounts receivable and credit sales, even though that might be a complete fictitious entry. But for your purposes, you want to analyze that to make sure, whatever industry you are in, what's the trend? Is it going up? Is it going down? Obviously, you want it to go down. But if it starts to go up, why is that? Is it you just had a huge, customer come in and buy, half your inventory, and that's why the AR to sales has gone skyrocketed up? You make sure you keep an eye on that percentage. And then concentration. You want to make sure that, hey, you may have a bunch of 2-3 big customers, and then you only have a couple little customers, but those 2-3 big customers represent, let's say, 70% of your revenue. Well, that's called a concentration, and you need to be cognizant of it. If you're okay operating that way, and maybe you have a unique product and there's only 3-4 customers in the entire US or wherever you're at, then you make sure you analyze, and from a business standpoint, if you do have a concentration, you make sure you take care of those customers. Whether it's returning phone calls promptly or getting their product immediately sent to them. Because if you lose those customers, what impact is that going to be on your financials? So that's, again, keep an eye on any concentrations you have. So now let's go ahead and take a look at the AR template. So this is the accounts receivable analysis template that you have access to. And the way this is set up is you can change these numbers, but you can't change anything else. And the reason being is these formulas here are important to see what happens. And I've set some criteria in here so that you can kind of see how it goes through. And now you can always go back and change the criteria, but I just set up certain criteria in here so that you can see how it triggers. Now, we're going to jump into this middle item here first, days in AR. What days in AR is, and sometimes it's called days sales in AR, is it indicates of the amount in accounts receivable, how many days of sales are sitting in there. So in other words, if you've got a whole bunch of sales in little AR, you think about how many days of just sales, if you didn't have any AR, would I have to get into that AR, or if I cashed or got all those accounts receivable collected, how much days of sales would I get in cash back? So it's going to be easier for us to take a look at this if I change some numbers so you can see it flow through. Now, the first thing before we do that I want to highlight is, see how I have 2 years here? you always want to have is, up to 3 to 5 years here. I only put 2. The reason being is you want to be able to see trends. Now, 2 is okay, 3 is better, 4 is better. Don't get too much past 5. I've seen some people do their analysis and they've got like 10 years, and because of the way economic cycles trend, a couple years, the country's in a recession and then we're out and then we're back in. It's the economy is like a pendulum if you think about it. It swings one way, super great, and it swings back the other way, super bad. So it's always going to do that. So that's why I caution getting too far out in your analysis, because you may end up picking up stuff that that year was really bad because the market crashed and all that, and it just skews your analysis. But you want to have at least 2 so you can kind of do a comparison. Now in here I just put $1 in here just so we had numbers. I wasn't going to go too wild and crazy in there because I wanted really for you to see these items. So in this case, with these fictitious numbers, it's saying that there is 12 days of sales in accounts receivable. Let's change this so you can kind of see. Let's say our total sales, and again, this is credit sales, not just sales. So don't just dump your full sales number in there because there may be cash sales. You want to put in what sales that are hitting your revenue are from credit. Whether you collected it subsequently is fine, but when it was initially booked as a sale, was it a credit sale? So in this case I said 150,000. But so you can get a better idea on this days in AR, let's go ahead and change that number to 5,000. So if we had $5,000 in sales and we have total accounts receivable of 5,000, that means our entire say a credit sales is sitting in accounts receivable. So 5,000. As you see, it calculates there's 365 days of AR in sales. Now you'll notice this popped up. Right now the formula I have in here is 45. So what I said is, if sale days in AR gets to greater than 45 days, then put up this warning that we need to take a look at those accounts receivable. Because again, 45 days, you think about that, that's a month and a half of sales that are sitting in your accounts receivable. That's cash you don't have access to. Now you can change this formula to 30 days if you want, or more, or 60 days, depending on what your industry is. But I set it at 45 just so that you can quickly dump this information. When that warning pops up, that immediately tells you, oh, hey, I need to look at that. Because again, if you're a small business, a lot of this analysis you're doing late at night and you're going to be tired. To have something just kind of pop up for you, that's going to be beneficial for you. So in this situation, let's pop that back so it goes to 12. Now let's go the extreme other way. Let's say we had 1.5 million in sales. So now it just says our days in AR is 1 day. And it's probably actually even less than that. But 1 day pops up. Again, that's pretty. That'd be very impressive if you could actually get to that point. But I just wanted you to see that as that flow through. Now I also put in this months in current AR, or months in the year. This you'll want to change. In this situation, obviously it says, we're through April. Because of how days in AR is calculated, it's calculated on an annual basis. There is a formula in here that goes through and does a calculation and says to the effect that it annualizes it for you. So that's why you want to put that number in there so that you can get to the calculation, because just on how days in AR is calculated. Now, this item, AR to revenue. So you're going to have to find out what your industry standard is. And again, you're going to look around, and if you have to, again, this is the beauty of how ratios work. You can look at a public company. If they're similar industry, similar product, you can see what their AR to revenue is. And sometimes that'll actually be in their what's called the manager discussion analysis. But find out, what's the industry norm for that. And are you too high, too low? Because if you're too high, if your AR, let's say, is 25,000, and our days in AR just went up, or our AR to revenue is 6%, and the industry norm is 3%, that could tell you, maybe I'm carrying too much AR. What's the issue there? So make sure you keep an eye on that number. And again, this is where you want trends. just getting 1 year is not going to tell you a whole lot on that until you start seeing trends come through. Um, so, and then bad debt to AR. Again, this is one of those items that you want to keep an eye on. Is in particular, you want to make sure that your accounts receivable clerk isn't just writing off AR. And the concern there, one, is control. That's a common way for a bookkeeper to steal from somebody is they collect the cash on a receivable and then they just write off the receivable so they can get it off the books, and they dump it in bad debt expense. So that's not always, no, keep in mind that's not always what's happening. There could also be you have somebody who didn't pay their receivable, and you've got an accounting manager that just says, I'm just going to write it off. I'm tired of calling Joe. He gives me the runaround. I don't want to deal with him anymore. I'm just going to write it off. Well, no, that's not what you want to do. So you want to just a simple little analysis of this, and let's just say in this situation they had $500 of bad debt expense. Now, $500 doesn't seem like a whole lot, especially if you had credit sales for the period of 150, but look at that. You're at 10% there. So you want to make sure that in this situation, bad debt to AR is 10%. You don't want to be writing that off. So again, I put in this analysis. Hey, you need to take a look at your write-offs. Are they getting too much? Are they too, is something happening there that you agree with? Again, bad debt expense, any write-off that happens, you want to personally look at. Don't let somebody make a decision on writing it off, because again, that's cash. That's your product that you sent out. You don't want to just allow somebody else to give that authorization to write something off. So now I'm guessing the wheels are spinning around in your head, and you're sitting there contemplating all the cash and AR and formulas going through your financials right now. So let's go ahead and take a quick little break, and when we come back, we're going to jump into inventory, and we're going to go through quite a bit in inventory, both the counting of the inventory and the ratios within the inventory, and also we'll continue on with the balance sheet. So I look forward to seeing you in the next part. Thank you.